Good afternoon. My name is Kir Kahlon. I'm the founder and chief investment officer of Scorpion Capital. We focused purely on activist short selling. We do a lot of deep dive investigative work, and then we publish pretty detailed reports that summarize our findings. We have a pretty specific focus. We focus exclusively on frauds and promotes, which I think are probably the best kinds of target shorts. If you're an activist, if you can expose something as a fraud, the report tends to have a much more dramatic impact than just talking about the upcoming earnings aren't going to be great, or something not quite as fundamental to the narrative that underpins a stock. So we spend all of our time trying to identify frauds and promotes. It's a question that I guess get asked periodically. There's no one great answer. I think you just have to have a pretty comprehensive toolkit. And I'll kind of walk through some of the different ways of finding frauds and promotes. And like with anything, the more you focus and concentrate on it, the more you pick up different little tricks of the trade. So I'll just throw out a few different methodologies. One of my favorite kinds of activist short candidates is something that's just too good to be true. Where the claim is so bold, it's so audacious, it just requires you to suspend disbelief. And stock market investors are often willing to do that. An example of that is there was a company I was short, and this was about 6 years ago, which claimed that they had found a stem-like cell, which they said could be coaxed into a fertilizable egg and sold as an adjunct to IVF treatment. And I remember when I read the 10K, I was like, this is just total baloney. If this is true, it changes the entire global fertility landscape. Women in the late 40s that have been through a dozen failed IVF cycles are suddenly having babies. I was like, there's just no way. And as we did a bunch of research, we found out that that the cell actually didn't even exist. A second way that I like looking for ideas, there's certain pockets, and those pockets can be a particular geography. Certain geographies like China, for example, or even Korea periodically, where you get clusters of really bad behavior, and you can have waves of pretty fraudy companies that come and go. So it can be by geography. There's certain exchanges, particularly junior exchanges, and this is no secret to anybody that spends time on the short side. You have the AIM market in the UK. You have junior exchanges in Europe. You have junior exchanges in Asia, and companies tend to list on junior exchanges for a reason, right? They can't meet the more stringent requirements of listing on a proper exchange, so those tend to be pretty good hunting ground. Another type of pocket for certain kinds of industries or niches within industries. So I tend to spend a lot of time on healthcare, all across healthcare, biotech, pharmaceuticals, medtech. And one of the reasons I focus there is because healthcare is complex. We all know the healthcare system in the US is completely screwed up. The incentives are totally twisted. So you get a lot of bad behavior. And because biotech companies are complex, the nomenclature is complex, investors, particularly retail investors that may not have MD PhDs, have no understanding of what the company does. That's a pretty big pocket, right? Like healthcare and biotech, where you can tend to find something where the trial was goosed, people don't understand the science. If you actually dig in, do the work, you realize it's pretty vaporous. And then within that, it can even get more interesting. Like pain management, as an example, is a pretty scammy space. There are a lot of publicly traded companies in the pain management space that kind of tend to come and go. Insys is probably the most famous one. They had an oral spray that they sold improperly, and since then the company's slowly blown up. People have gone to prison, prescribers have gone to prison, executives have gone to prison, and pain management is kind of like the gift that keeps on giving. So there are a lot of different pockets like that in different industries, and sometimes they're a function of the particular phase that you're in the market, right? So SPACs have been a pretty target-rich pocket for the last year. There are a lot of active short sellers that have gone after SPACs. The last report that we published was on a company called QuantumScape. That's a SPAC. So I think you have to have this mentality where you focus on certain themes and pockets, and some of them just are generally always there. Some of them are kind of hot and cold depending on the year. So you have to have a pretty wide toolkit. I mean, I can keep going into more and more ways of finding ideas, but that's just a little bit of a flavor. There's certain kinds of screens that I think are really interesting. There are about 50 different screens that that I run, I think the three screens that are almost fundamental for any short seller are highest price to sales. So you find some company trading at 50 to 100 times revenue, right? There is no way that company is ever going to grow into its valuation up. You might be waiting a decade, for the stock to blow up, right? But at some point, you're going to be right, hopefully sooner rather than later. So just doing a screen for high price to sales and things over 100 times revenue generally make pretty good shorts at some point if you get the timing right. The second one is high short interest. And there are a lot of academic studies that show that the amount of short interest is actually pretty predictive. Again, you have to be very careful because there's certain waves where the most shorted stocks are the ones that go up the most. Like when you're bouncing off of a bottom or when the market is just going totally vertical, like those crappy companies and highly shorted stocks will get squeezed. But over time, they tend to do better. But it's pretty good hunting ground because if something has 20, 30% short interest and nobody's written about it, I might look at it. And then you kind of fill in what people are uncomfortable about, but you fill it in with like real research and you explain what's going on. And then the report ends up being a catalyst and an impact. So high short interest. And the third is stocks that are up the most. I like looking at stocks that are up the most in 3 months. So if something has doubled or tripled in 3 months, it's probably not sustainable. You can kind of pick your time frame. And where it gets really interesting is if a stock shows up on all three of those screens, which is actually pretty common, right? So it's north of 50 to 100 times revenue. It's tripled in like the last 2 months. It's pretty highly shorted. There's going to be some heat there, right? Like it's probably going to blow up. So that's the way that we identify an idea. And, to be honest with you, identifying ideas is not the hard part. When I first started looking at frauds and promotes, that was actually the hardest part, finding something that's a fraud. And, it's not that easy, right? If you're trying to go after something with multi-billion market cap, you have really smart holders, there's not going to be a sign on the door saying that this is a fraud, right? Like, there are bodies that are going to be buried. You got to do a fair amount of work, but that part of it is the easiest now. So the list of things that we can go after is actually quite long. It would keep us busy for a fair amount of time. Where it gets intensive is when we implement our research process and we actually start working on something. And the hurdle for us to even start working on something is really, really high because we know it's going to, suck up a month, 2 months, 3 months. So it's almost never the case that we actually kick off a deep dive and we find out that our initial thesis was wrong just because the level of certainty and initial evidence is to be so compelling for us to even go down that path. Every short seller, every investor has their own type of research process. Some people do 20-page models. Some people have 2-line models. Some people have no models at all. Our process tends to be very call intensive. It's kind of like being an investigative journalist where we are trying to identify sources that we can talk to. Because we're investors, we have certain compliance frameworks that we have to operate within. We can't talk to anybody that works at the company, but former employees are fair game. So we identify former employees. We'll find them on LinkedIn. We'll use expert networks. We'll look at press releases, and we tend to do a 360, depending on what's relevant for that particular company. If it has customers or distributors, we might try to find some of those. We always try to talk to a pretty good sample of former employees. It's kind of like a magic number I found where it's about 12 to 15 calls where things really start clicking, particularly for fraud, right? Where the bodies are buried and it's not obvious. So the first, 10, 12 calls, you're asking questions, you're getting close, you're getting warm. And then once you know where the bodies are buried, your questions can get very, very specific. And oftentimes people will answer the question if they kind of know that you know what's up, but they're not going to reveal it. And then when your questions get more specific, obviously the answers get, much more interesting. So I found that, kind of call 0 to 12, you're learning a lot, you're getting good evidence, good research. Calls 12 or 15 to 20, sometimes just go bonkers, like, with the quality of the research that you start accessing at that point. So we tend to do a lot of calls, ends up being expensive, takes a lot of time. And then there are things that are specific to the kind of research. Because we do a lot of healthcare, we spend a lot of time reading the science. Right, we'll pore over the clinical data, the studies that they've done. We'll read medical journals. We'll talk to scientists that might know about that kind of molecule, that mechanism of action, even though they don't know anything about that particular company. There are situations where we have contemplated, paying a scientist to, replicate the research that a biotech company has done because we sensed that the research was fraudulent, and we wanted somebody to, redo the science just so that we had, more confidence that was the case. So, that is very creative. That also gets very expensive. Not many people have the, the stomach to do things like that. But our goal on Schwartz in general, when we put out a report, is to kind of really set a benchmark for the highest quality, most in-depth research that anybody's ever published on that company. Now, we're not always going to succeed. There are always going to be people that criticize our research, but our internal objective is really that high, and that just keeps us honest, and it makes sure that we're putting out things that are interesting to other investors in the market.